Everybody, this is lecture for week 3, lecture 1. This week, the topic is topic 3. You will learn about accounting process. Starting from this week and starting from this topic, you will learn about how to do accounting record. Okay, firstly, you have to remember the definition of accounting, specifically for financial accounting. So financial accounting is a process to analyze and record business transaction and to report financial information. That is the financial statement. So the input of financial accounting is business transactions. And then you have to record this, you have to analyze this business transaction, and then you have to record this business transaction, and at the end of the month, at the end of an accounting period, you have to prepare financial statement that contains income statement, balance sheet, and several more. Okay, that is the financial accounting. So let's see the accounting process. So in this topic, you will learn about how to do the accounting record for a business. Okay, the way to do accounting record is called accounting cycle. Accounting cycle explains the way to do accounting record for a business. Okay, this is the easier way to understand the accounting cycle. So the first step to do accounting record is analysis. You see here in this slide, number 1, step 1 or number 1 is the analysis. So if you want to make an accounting record for a business, the first thing that you have to do is to do the analysis. So the analysis is happen after a business do a business transaction. So during the analysis, you have to know the type of the transaction, effect of the transaction on the accounting equation, and the amount. You will see the detail in the later slide. The second step is to record the transaction in the journal. Journal is the first book in the accounting process. Step 3, you have to transfer all the journal entries into the ledger. Ledger is another book in accounting. And then after you have transferred all the journal entries into the ledger, and then you have to calculate the balance for every account in the ledger. Step 4 is you prepare a trial balance. You will see that in the next slides. Step 5, you do adjusted entries. After that, you prepare an adjusted trial balance. An adjusted trial balance is a trial balance you prepared after you have done the adjusted entries. And then step 7, you prepare the financial statement. In this course, you will learn about how to prepare the income statement and balance sheet. And the final step in the accounting cycle is the closing entries. So the accounting cycle will end at the end of an accounting period. So let's say you have a business, and then you have to do accounting record for this business. If the business is started at 1st of January, then you will start the step 1 at 1st of January when the business is started and the business makes business transaction. And then after that, you have to do step 2, step 3, step 4, step 5, step 6. And at the end of the year, you will do the closing entries. And when a new year is started, you will start with step 1 again. So that's why we call this accounting cycle. It is like a cycle. In one accounting period, you have to do step 1 to step 8. When a new accounting period is started, you will start from step 1 again. Okay, we will see that step by step. So step 1, like you have seen in the previous slide, step 1 in the accounting cycle is called analysis. Analysis means you have to analyze transactions or business transactions and determine how those transactions affect the accounting equation. Okay, let's see what is about it. Okay, so you have to know that a business will do many transactions every day. If you have a business, you will do many transactions. The business will do many transactions. These are the typical business transactions that will happen if you have a business. So first, see here, if you have a business, you buy something and you sell something, or you provide services. When you buy something, that is a business transaction. That is an example of a business transaction. When you sell something to customers, that is also a business transaction. You borrow money or you invest money, your business borrow money or your business invest money, that are also transactions. Your business purchase land, building and equipment, your business pay taxes, your business distribute earnings to owners, your business pay wages to employees. These are all transactions. So the step 1 of the accounting cycle is started after a business made a transaction. Let's say you have a business, you sell something. After you sell that thing, the step 1 of the accounting cycle is started. You have to analyze that transaction and then show the effect of that transaction on the accounting equation. So let's see. So in accounting, you have to be certain that a transaction had happened. So it is certain that a transaction happened if a business has source documents. The source documents are evidence that a transaction had happened. See here, examples of source documents are bills from supplier, sales receipts, checks, purchase orders, payroll records, and bank statements. There are many more. These are simple examples of source document. So for a business, to show that a transaction really happened, the business has a document. For example, when a business sells something to customer, the business will produce receipts. So that receipts is an example of source document. That receipts is an evidence that a transaction, a sales transaction had happened. Bills from suppliers. It is a document. It is an evidence that the business has purchased something from supplier. Sales receipts, checks. There are two parts of a check. If you familiar with using check, you will know that when you issue a check, then there are two parts of the check. Half of the check will go to the person that received the check, and you as the issuer of the check will keep a small part of the check. It is called check bar. That check bar is an evidence that you have paid somebody. Okay, that is a document. Okay, payroll purchase orders is also a document. Payroll records, it is a document. It shows an evidence that a business has paid the workers. Bank statements is a document. It is a source document. It is an evidence that there are transactions between the business and the banks. They are saving. The business deposit cash. Sometimes the business use cash, or the business issue check. It is also showing the bank statement is an evidence of a transaction had happened. Okay, and then that is about the business transaction. And then, like I said earlier, during the analysis stage, you have to know the type of the transaction, and then you have to show the effect of that transaction on the accounting equation. So this is the accounting equation. In accounting, we have this equation, and we use this equation during the recording process. Okay, the equation is like this. Assets always equal to liabilities plus owner's equity. Okay, let's see. Okay, assets of a business equal to the liabilities of the business plus the owner's equity. Owner's equity is the amount owned by the owner of the business in the business. If you do not remember about the definition of these three concepts, then you have to check previous lecture videos, because I have explained about these three concepts. Okay, let's see here. So I will try to explain briefly about these three things, three concepts. Okay, assets. Remember this. Assets are resources owned and controlled by the business. If there is a business, the business has assets like building, maybe, equipments, furniture, motor vehicles, maybe, inventories. These are all assets, things owned by the business. So let's say you see a business and you see everything. You go into the shop and you see everything in the shop is assets. Okay, so let's say in total the assets of this business, let's say $20,000. So where this $20,000 are coming from? How the business purchase this asset, $20,000. So the business purchase these assets either by borrow money from somebody, or borrow money from bank, or from the amount contributed by the owner of the business. If the assets are 20,000, you know how this business purchase this asset. The business purchase these assets using borrowings or liabilities, or using the amount contributed by the owner of the business into the business. Maybe the situation is the assets are 20,000. So how this business got these 20,000 assets? Maybe the business borrow 5,000, and another 15,000 is coming from the owner of the business. When the owner of the business started the business, the owner put $15,000 into the business. So $15,000 owned by the owner, or the owner's equity, plus 5,000 the business borrowed from bank. This 20,000 is used to purchase the $20,000 assets. So that is the logic. Assets of a business always equal to liabilities plus owner's equity. Okay, now how to do the analysis? Okay, like I said earlier, for the analysis tab, the thing that you have to do is you have to know what is the transaction, and then what is the effect of that transaction on the asset, liability, and equity. So let's say there is a business. The business borrow money from bank, 5,000. So when the business borrow money from bank 5,000, what is the transaction? Is the borrowing transaction. Okay, what is the effect of that transaction on the asset of the business? You can imagine the business is somewhere, and then the business borrow 5,000 from bank. What will happen? Bank will send cash 5,000 into the business, or the business receive 5,000 cash from bank. So what happened to asset? The asset of the business will increase because cash is asset. So business receive cash 5,000. So asset cash increase. At the same time, in the right side of the equation, liability also increase because the business borrow money from bank. Asset cash increase, liability, the bank loan also will increase 5,000. Asset increase 5,000, liability increase 5,000. There is no effect of the transaction on the owner's equity. Okay, because the owner does not do anything. When the business borrow money, the transaction is borrowing transaction. The effect is asset increase, for example 5,000. The second effect is liability increase. The liability is the bank loan or borrowings, 5,000. So that is the effect of that transaction on the accounting equation. The effect is always balanced. If the effect is 5,000 in the right side of the equation, in the left side of the, if the effect of the transaction is 5,000 in the left side of the equation, in the right side of equation, the effect is also 5,000. It is always equal. You can look at the equation. Asset always equal to liability plus equity. Okay, let's see the second example. Invest in company. Invest in company is like this. There is a business, and then the owner of the business put 15,000 cash into the business. That is an example. The owner of the business put 15,000 cash into the business. So what will happen to the asset of the business? Remember, in accounting, the business and the owner of the business are different. We do accounting record for the business. Okay, so if the owner of the business invested 15,000 into the business, the thing that will happen is asset cash will increase. So there is a shop, the owner put 15,000 cash into the business, so the asset cash will increase 15,000. The asset cash of the business will increase 15,000. At the same time, in the right side of the equation, there is no effect on liability. The business does not borrow anything from anybody. No effect on liability, but owner's equity will increase. Owner's equity, that is the amount, the account capital. The owner of the business put 15,000, so the owner's equity is increasing. Is increased by the same amount. Asset increase 15,000, owner's equity will also increase 15,000. Okay, pay off a note. Okay, this one is like the business pay the bank loan. What will happen? What do you think? Let's say there is a business, the business pay bank loan $1,000. What will happen? Imagine there is a business, the business pay $1,000. So the asset cash of the business will decrease, because when the business pay $1,000 to the bank, and the cash, there is a cash out. The cash from the shop or the business goes out to the bank. So asset will decrease 1,000. In the example is asset will decrease 1,000. And then what happened to the liability? The liability also will decrease. Before this, the business borrow from bank 5,000. Today, let's say this transaction happened today, the business pay the bank 1,000. So what will happen to the bank loan? The bank loan will decrease from 5,000, decrease 1,000, becomes 4,000. So the effect of pay of a note or pay a bank loan is the asset will decrease. In our example, the asset will decrease $1,000. The bank loan also decrease by $1,000. The bank loan is the liability. There is no effect on owner's equity. Purchase equipment. Okay, what will happen if a business purchase equipment? You can imagine there is a business, and then one day the business purchase an equipment. So the thing that will happen is, let's say the business purchase a machine. The price of the machine is $2,000. What will happen? First, the business will pay $2,000 cash to the supplier of the machine. Okay, so when the business pay $2,000 cash to the supplier, cash goes out. So asset cash will decrease $2,000. And then after the business pay the $1,000, the supplier will send the machine into the business. So asset machine increase $2,000 because the value of the machine is $2,000. So when the business purchase an equipment, the thing that will happen is asset cash decrease, asset machine will increase. So the effect of the transaction is like this. Two effect on asset. Increase 2,000, decrease 2,000. So it is zero effect. So you see there are two effect on asset, but there is no effect on liability and equity. There is the business does not owe or borrow from anybody, and also the owner of the business does not do anything. So no effect on liability and no effect on equity. So let's see the next thing. Let's say the transaction is like this. A business borrow fund to settle a debt. Okay, this is not always happen, but it can happen. Let's say a business has a debt $10,000. The business actually has to pay it now. This let's say this month. So the business has no cash to pay that debt. So the thing that the business do is borrow from other places. So the business borrow from, let's say, another bank. So a business has a bank loan $10,000. The business has to pay today. The business borrow from another bank $10,000 and use that amount to pay back the due loan. So what will happen to the accounting equation if this transaction happen? So the thing that will happen is the business borrow fund. When the business borrow fund, the liability of the business will increase. The liability is debt, so the debt increase. And then after the business receive the cash from borrowing, the business pay another loan, so the liability decrease. So increase in liability, at the same time there is a decrease in liability. So see here, the thing that you can see is when you try to identify the effect of a transaction on the accounting equation, the thing that can happen is sometimes there one increase in the left side of the equation and one increase in the right side of the equation. Sometimes there is one decrease in the left side of the equation and one decrease in the right side of the equation. Sometimes the effect is two effect on the left of the equation only, and sometimes there are two effect on the right side of the equation only. It depends on the transaction, but you have to know the effect. Okay, the analysis is happen in the mind of the person who do the accounting record. Let's say you the person who you have to you have to make accounting record for a business. So the first step is the analysis, and this analysis happen in your mind or in your head only. The second step in the accounting cycle is journal entries, to do journal entries. Okay, journal is the is called book of original entry. Journal is the first book that we use in accounting. Journalizing provides a chronological record of all business activities. Chronological means the records in accordance with the times the transaction happened. So if you have a business, you have to do accounting record for this business. You have to follow the accounting cycle. The first step in the accounting cycle is when a transaction happen, you analyze the transaction. That is the first step. After you analyze, the analysis happen in your mind. After you analyze, you do the second step, which is to record the transaction in the journal. The journal is the first book that we use in accounting. Okay, there are many types of journals. Cash receipt journal, cash payment journal, and then sales journal, purchase journal, sales return journal, purchase return journals, and there are several more. If you check the textbook, maybe there are several more, but typically these are the 6 type of journals. Plus there is another one called general journal. General journal is special. You can record everything using general journal. So in this course, ACN3101 and ACT3110, you will learn about how to record everything in general journal only, to make it easy for all of you. Okay, to record transactions in general journal, the first thing that you have to do is you have to know the rule of debit and credit. Okay, remember this. Debits are simply entries on the left. Debits means left, or entry or record in the left side. Credits means right, or record in the right side. So if somebody mention debit, so you have to remember debit means left, record in the left or left. Right, credit means right, or record in the right side of an account. Okay, this is the rule of debit and credit. Very easy to remember. Okay, remember this. For asset, if there is an increase in asset, you debit. If there is a decrease in asset, you credit. For liabilities, it is the opposite. For liabilities and owner's equity, it is the opposite of the opposites of the asset. For liabilities and equity, if the liability and equity increase, you have to debit or record in the left side. If there is an increase in liabilities and owner's equity, you have to credit. See here, very easy to remember. You have to memorize this. There is no other way. Asset increase, you debit. Asset decrease, you credit. Liability increase, you credit. Liability decrease, you debit. Equity increase, you credit. Equity decrease, you debit. Okay. Okay, but owner's equity is related to 4 accounts. First, owner's equity is related to capital. Capital is something like this. In accounting, capital is something like this. If there is a business, and then the owner of the business put cash into the business. Typically it happened when the business when the owner of the business started the business. So when a person started a business, he or she will put cash into the business. Let's say the person put $10,000. So in accounting, that $10,000 will be recorded in capital account. So when you see capital account, you know, oh, that account is for recording when a person or when an owner of the business put something into the business. Maybe it is cash, maybe it is other asset. So that is account capital. And also, owner's equity is related to another account called profit. In accounting, if a business makes profit, the profit belongs to the owner of the business, because he owns the business. He or she start the business and put capital in the business. So if the business is making profit, then the profit is belong to the owner of the business. That's why it is related to owner's equity. If the business is making profit, then the owner's equity will increase. Okay, how to calculate profit? In accounting, the way to calculate profit, the simple formula to calculate profit is revenue minus expenses. Okay, so now you know that revenue and expenses also related to owner's equity. If revenue is higher than expenses, then the business is making profit. The profit belongs to the owner of the business. But if the expenses are higher compared to the revenues, then the business is making loss. The owner of the business has to accept the loss, to bear the loss. Okay. So when a business makes profit, the profit belongs to the owner of the business. If the business is making loss, also the loss is to be owned by the owner of the business. Okay, so remember this. Revenue increase for capital if the owner of the business put capital into the business, the owner's equity will increase. So how to record that? When the owner of the business, when the capital increase, you have to debit. You have to credit. Why you have to credit? Because when the owner of the business put capital, the owner's equity increase. Equity when increase, you credit. Okay, let's see the revenue and expenses. When a business generate revenue or makes revenue or receive revenue, the profit will increase. When the profit will increase, the equity will increase. So equity increase, credit. So that's why when you record revenue, when the business receive revenue or got revenue, you have to credit revenue account. Why you credit? Because the revenue means profit will increase. So profit increase, equity increase. Equity increase, you credit. But for expenses, when a business has to pay expenses, it means that the profit will decrease. When the profit decrease, the owner's equity also decrease. So see here in this, the above box, when the owner's equity decrease, you debit. So expenses, when a business makes expenses, you have to debit the account. Debit account, expenses. So you have to memorize this: capital, revenue, and expenses. There is another account. The account called drawings. Okay, drawing is something like this. Drawing is also related to owner's equity. Drawings account is an account where drawing is an account that you use when the owner of a business takes something from the business. So let's say there is a business, and then one day the owner of the business, he need cash urgently. So he take the cash of the business, $1,000. So in accounting, when the owner of the business takes something from the business, including cash or other assets, you have to record that in an account called drawings. Drawing means the owner takes something from the business. Drawing means drawing means the owner of the business takes something from the business. and this will decrease the owner's equity. Let's say the owner of the business, when he started the business, he put $15,000 in the business. So this $15,000 is capital. This is related to the owner's equity. So several months later, he need cash urgently. He takes $1,000 from the business. So now, how much is the amount owned by the owner of the business in the business? Now the amount is only 14,000. He invested 15,000 when he started the business, and then today he takes $1,000. Then the total owner's equity is $14,000 only, because $15,000 minus $1,000, $14,000 left. So remember, owner's equity is related to 4 accounts: capital, revenue, expenses, and drawings. Capital increase, you credit. Revenue increase, you credit. But expenses increase, you debit, and drawing increase, you also debit. Okay, that is the first thing that you have to know when you want to record a transaction in a general in the general journal. Here, just want to show you the common account names that you will use when you record transactions in general journal. Okay, current assets. What are the typical or common current assets account? They are cash, account receivable, inventory, and supplies. Okay, inventory is for merchandising business and manufacturing business. If you have a merchandising business, let's say you have a grocery shop, you will have inventories because you will sell things like rice, sugar, flour, etc. These are inventories. If you have a manufacturing business, you will have inventories. You have raw material inventories, finished goods inventories, etc. But if you have a service business, do you have inventories? If you have a service business, let's say you have a laundry shop, do you have inventories? No, we call the thing if you have a service business, you do not have inventories, because a service business does not sell anything. You have a laundry shop, you provide services, not you are not selling anything. But when you provide the laundry service, you have to use things like detergent, softeners, etc. Okay, these things are called supplies. In accounting, we call them supplies, because the laundry business does not sell anything. The laundry business use supplies like detergents and softeners, etc. to do the service. Okay, that is the difference between inventory and supplies. There are other common account names for non-current assets: land, building, furniture, and equipment. For current liabilities, what are the common account names? Account payable and salaries. Account payable is like this. In accounting, if you have a business and one day you purchase supplies from supplier, but you will pay next month, you purchase in credit, so the amount that you owe to the supplier, you record in account payable. Salaries payable. Salaries payable is something like this. You have workers. Today is 31st of October. the workers has worked this month, but you will pay salary at 5th of November. So today you have to record the amount that you still do not pay to the worker as salary payable. He has worked this month, but you will pay later. So this month you have to record that as a payable, salaries payable. That is the salaries payable. Overdraft is something like this: short-term borrowing made by a business from bank. Overdraft is you have to read more about overdraft. The thing is like this: if you for an individual, you have credit card, the bank will, let's say you have a credit card, maybe the bank allow you to use the credit card maximum $5,000, so you can use that anytime. It is a borrowing, but you can use it anytime. Overdraft is the same facility, but for a business. The bank will allow the business to use certain amount at any time. Okay, so it is like a borrowing. And interest payable is like this: let's say a business borrow money from a bank, and then at the end of 1 month, the business has to pay interest for the borrowing, but the business does not pay it yet. So the unpaid interest has to be recorded in account interest payable. Okay, I forgot to explain about account receivable. See the first point in this slide, account receivable. Account receivable is a current asset. The thing is like this: let's say there is a business, and then one day a customer come, the business provides services to this customer and charge this customer $50. So the customer said he will pay that $50 later, 2 weeks in the future. So the $50 has to be recorded in account receivable. In accounting, the amount that will be paid by a customer in the future has to be recorded in account receivable. Okay, the point number 4, long-term liabilities. Common account related to long-term liabilities is long-term loan or bank loan. Okay, equity. Account related to equity is capital, revenue, expenses, and drawings. Okay. Okay, this is examples of how you should record transaction in general journal. Okay, this is the format of a general journal entry. When you want to record a business transaction in the general journal, you have to use this format. First, you have to write the date of the transaction, and then you have to show the debit entry, and then the XX there is the amount related to the entry. And then after that, below the debit entry and a bit to the right, you have to show the credit entry. And also you have to show the amount related to the credit entry. The XX there. XX means the amount related to the credit entry. And also, under the entries, you have to write explanation. Okay, I will stop now. And after this, I will prepare a second part of this lecture, which is I will explain about how to do records in the general journals. Thank you very much. Do not forget to write your name and matric number in the comment section. I will take that as the lecture attendance.